Okay. So firstly, thank you to those of you who've made it. Very much appreciated, and hopefully it's of some value to you. You'll get something out of it. If, like I say, I have got a very boring voice, so apologies for that. Don't let that put you off. Try and get some value out of it. We're going to talk through, it's a bit of a recap on the most recent changes that could impact on your clients. So it'll be Craig, who's a partner at Cowgills and a fellow insolvency practitioner, who'll be interjecting on some of the slides to keep things fresh. And we're going to go through, apologies by the way if you can see our distorted faces on the right hand side. That was my pathetic attempt at trying to get our faces on the screen, and I've made him look fat and me look thin. But the slides will be as follows. We'll be talking through the Corporate Insolvency and Governance Act, which was intended to give businesses protection from the creditors during the pandemic, and that's still ongoing. Similarly to that is the landlords and tenant forfeiture provisions, which again is preventing landlords from forfeiting leases and kicking tenants out. Then I would arguably say the most important section for you guys is the Finance Act and the consequences of the misuse of government reliefs. That's something that we're really starting to see a change in the landscape, and we think there'll be heightened aggression from the government in pursuing those abusers of the reliefs. Then the COVID-19 budget, which is relatively recent, and the recovery loan scheme, which is the newest form of funding. And then the proactive steps that you can take yourselves or in conjunction with us to protect your clients and give them the best advice. Just some pointers on that you may or may not already be aware of. Okay, so over to you, Craig, to kick off.
Cheers, Ben. Morning all, and thanks for joining us. It's great to see so many of you on this sunny morning, and we really do appreciate you taking the time out, whether that's from your living rooms, your kitchens, or your offices in this new digital world that we're in. So as Ben says, I'm going to start off this morning with a quick overview and update on the Corporate Insolvency and Governance Act 2020. It came into force in June 20, introducing both permanent measures, which were to update the UK insolvency regime, and also temporary measures to give struggling businesses a lifeline during the coronavirus pandemic. Temporary measures were for an initial 3 months, but this has been extended on a number of occasions and now has been put back further until June 21. So as I say, the intention was to provide breathing space, but this was aimed at solvent businesses who were affected financially by COVID. It was very much not intended to assist businesses that were teetering on the brink, no longer considered viable, or in fact insolvent going back to March 20. So let's touch upon some of the reliefs that were put in place. Most notable was the suspension of creditor enforcement action. This included the filing of statutory demands and winding up petitions. Wrongful trading actions against directors were also suspended, but this only applied where it could be demonstrated that the problems encountered and the financial position of the business were directly impacted as a result of the impact of COVID. That being said, it was still noted that directors should be acting responsibly, and the necessary checks and balances would be required if a director's conduct was called into question. It wasn't quite the carte blanche that I think people had in mind. Furthermore, the introduction of the Finance Act meant that there could still be significant problems for directors personally once the reliefs are brought to an end. And as Ben said, I'll touch on the Finance Act shortly. Next slide, please, Claire. There were some additional reliefs brought in under the Coronavirus Act relating to the landlord and tenant forfeiture provisions, and this meant that landlords were unable to forfeit leases for unpaid rent and rates. This specific provision came into force in June 20, and again that was for an initial 3 months, but it's since been extended on a number of occasions for December 20, March 21, and now up until the end of June. Also, commercial landlords were prevented from using the previously existing recovery procedure known as CRA, or the Commercial Rent Arrears Recovery Procedure, whereby they could seize a tenant's goods and potentially sell them to cover rent arrears. However, it must be said that any arrears from tenants subject to this relief must have been as a result of COVID. And where companies were able to afford to make payments, they should, of course, continue to do so, whether that was in full or in part. Next one, please, Claire. So I've touched upon the positive steps taken by the government in the event of the crisis. Fantastic support measures that were put into place, which have obviously helped a number of businesses who the support was aimed at. However, what's becoming more and more apparent is that due to the significant pressures, the time constraints, that the qualification and eligibility requirements probably haven't been as stringently qualified as what you might have expected previously. And this, of course, means people will no doubt have taken advantage. So this takes us on to the Finance Act, which gained royal assent in July 20. And the Finance Act contains various measures to combat the misuse of reliefs and support obtained as a result of COVID. According to published stats, total government support as at December 20 totaled £133 billion, which is obviously quite alarming. Yet going back just a few months prior to October 20, HMRC's fraud hotline was ringing off the hook, racking up 10,000 calls a day, reporting alleged fraudulent claims in relation to furlough and other various government-backed loan schemes. In light of this, HMRC had an armistice the 20th of October for payments that were claimed falsely or in error to be returned without further repercussions. But this date has obviously now passed. So what will happen to the guilty parties? Well, Schedule 16 of the Finance Act covers the action that might be taken against these companies or individuals and provides that any person who has received support payments that was not entitled to it, either because they shouldn't have qualified for it or they didn't use the monies in accordance with the specific rules laid down, they used it personal means, etc., they may become liable for that amount, plus a 100% penalty. If the company is given a liability notice under this section and can't afford to pay or enters formal insolvency as a means to get out of paying the debt, then the directors are jointly and severally liable personally. Well, that bombshell pretty much concludes my part, so I'll now pass you back to Ben. Thanks for listening. Cheers.
Thanks, Craig. I forgot to say in my haste at the outset that if anybody does have any questions, you can put them in the chat box. I think it's just at the bottom of your screen. And we'll address any questions at the end. Okay, so the COVID-19 budget, the key points really were that furlough and self-employed support were extended again till the end of September. There was further extension, the Corporate Insolvency and Governance Act, protection from creditors, and the landlord and tenant rules. There's also the introduction of the recovery loan scheme, which I'll touch on in a second. And again, probably most important from your point of view, possibly, is the creation of the task force, which really does show the government's intent. They've got 100 million plus invested with over 1,000 furlough fraud investigation officers. So that does show how much they are intending on recouping some of the money that they've put out. So the recovery loan scheme, as I said at the outset, it's effectively a replacement of the current funding reliefs, CBILS and bounce back loans. And businesses can currently apply up until the end of December 21. In terms of how much you can apply for, loans and overdrafts between 25 grand and 10 million per business. Invoice finance and asset finance between £1,000 and 10 million per business. Again, continued theme that the government guarantees 80% of the finance to the lender, but important to recognise that the borrower remains 100% liable. Having said that, no PGs to be taken up to £250,000 of borrowing, and borrower's principal private residence cannot be taken as security. The finance terms vary, up to 6 years for loans and asset finance agreement and up to 3 years for the overdraft and invoice discounting. The criteria, again, the company, I mean, it's hard to prove at times, but the company must be viable, or would be if it wasn't for the pandemic, and has been impacted by COVID-19. And also, the recovery loan scheme can be used in conjunction with other government-backed borrowings that already might be in existence within that particular entity. Next one, Claire, please. Okay, so Craig touched on, we're all really aware of the level of reliefs and how much the government has tried to assist businesses. And since then, has revisited repayment terms, extended them, and it's all really been in an attempt to avoid an avalanche of corporate insolvencies. And that has definitely been the case. Certainly will have impacted on us, but overall, I think it was a 40% decrease year on year from 19 to 20 in corporate insolvencies. And the intention was to save solvent businesses and not give a pulse to those that were already insolvent. And as I've said, we expect particular attention to be given to the misuse of reliefs. And we've seen with the government hotline and the newly created task force, the intention there. We've certainly experienced an increase in activity in recent months. And that is, I think, because business owners are now facing up to the fact that they're going to have to start repaying some of these borrowings. And not only that, it's also in conjunction with a build-up in the other arrears, whether that be HMRC liabilities or rent, your usual business costs that will have been rolled up. Is probably quite an intimidating thought for a lot of business owners now, I would think, when they start to think, how on earth are we going to start to pay this back? All of the usual red flags that we would look for, as would you guys, have been inactive in terms of the usual things that you would look for when trying to establish whether a business is insolvent. They've been inactive, and therefore the position has been really suppressed, and we expect that to start to unwind now, and we expect ourselves to get busier and busier. Next one, please. Okay, so what can you do? What proactive steps can you guys take, whether it's just on your own or in conjunction with somebody like us? Firstly, cash flow forecasting. As I've just said, that's going to become particularly important to be on the front foot with that in order to try and foresee any bumps in the road well in advance because of the build-up in arrears as well as the additional borrowing. As businesses start to reopen, they're going to have to really assess whether they're going to be able to meet their ongoing and historic liabilities. Time to pay arrangements, that's been an interesting one. Historically, we always discussed time to pay arrangements as being around a year, sometimes 18 months, but the HMRC seemed to have been particularly sympathetic over the last kind of 10 months, really. And we've seen some time to pay arrangements getting through where it's up to 4 years, which was previously unheard of. Again, if that's something that you're well versed in and you think you can do on behalf of your clients, that's great. If you want some assistance with it, please pick up the phone to us and we'll do something together. Directors' loan accounts. It's a real something that I'm really keen on. They're one of the few balance sheet items that can really hurt directors personally. So obviously you've got your regular borrowings that may or may not be PG'd. If they're PG'd, of course, it's going to hurt them personally. The director's loan account is sometimes one that gets overlooked by directors, and they don't realise the long-term implications of that. An insolvency practitioner is more often than not going to come chasing for that director's loan account if a company enters formal insolvency. So well in advance of that, I'd be looking at how you can address that, how you can tidy it up, how you can reduce it, make them aware of it, encourage them not to increase it any further. And then it gives them, if the company does enter formal insolvency and they want to restart again, it gives them a fighting chance of being able to afford to do that. Consider refinance. If your clients may want to look at their existing facilities, if they have any, and if you're not sure whether they've got the most appropriate lending facility in place, then please again pick up the phone to us. We've got somebody that does that all day, every day. He's a specialist in that, and he'd be more than happy to run through the options with you and your clients. Coming back to Cowgills, I would obviously tell you how good we are, but we've got 5 qualified insolvency practitioners that head up the team. We've got one of the biggest teams in the north now, and I really think that at this moment in time, more than ever, it's important for you to be able to pick up the phone to people who are technically competent, who have a true understanding of the most recent changes, and importantly can approach it with a commercial outlook for your clients. And I really would put us right up there with all of those attributes. I think we can really assist. We're not about chasing fees. We're not about forcing companies into insolvency and trying to persuade directors to engage us as insolvency practitioners. We're more about a longer term relationship and giving the right advice. If that results in a formal insolvency, great from our point of view. If it doesn't, hopefully it reflects well with you as referrers. We'll always be available to do a health check, a free consultation on your clients, and to assess whether the business is genuinely viable. And if it's not, we would encourage the directors to take advice from an insolvency practitioner, whether it's us or somebody else. And that is about it. So thank you very much for coming on and listening to us both drone on. Hopefully you'll get something out of it. And if you want to get in touch with us further down the line to ask anything, then please do. Claire, are you back in the room? You're on mute.
Sorry, with us, yeah, I'm here. There aren't any questions as yet, but as you've just said, Ben, if there are any questions, I will be sending an email out with the details of the event, the slides and the recording of the event. So if you have got any queries, then I'll make sure that Ben and Craig's contact details are included on that email. Thank you very much. Okay, so there's nothing to answer now then? No, nothing in the chat box at all. We must have been boring. Everything. We must have been boring. No, we'll get those slides out to everyone, will we? Yes, we'll get them out this afternoon, and as I say, a copy of the recording as well. Thank you. I don't think they'll be watching that again. I think they just once was more than enough. Yeah. Unless they've got deep anxieties at night and they need sending off to sleep, I would refrain from. I prefer it if you didn't send that video out. Actually. We'll send the slides. All right, brilliant. Thanks all. Thanks. Cheers, Steve. Thank you. All right, take care, everyone. Thank you. Bye.